Yo, what's up? This is Patrick from TSH FX Institute, and today I want to actually give you a simple trick that you can use when trading Nasdaq, US30 or US 500. So we're gonna go into the charts and see what kind of setups the market present and how they appear and when to execute and when to exit your trades. So as we are looking on the Nasdaq 100, as we can see, this is Monday, beginning of the week. This is Monday, beginning of the week, and we all know that in the beginning of the week there is a lot of accumulation to induce the traders to go the wrong way. So what they usually do is they will consolidate the market and then they will give you this kind of candles as a breakout. For these kind of candles, the retail traders see it as a breakout, and that's also one of the inducement, and that's how they will take their entry based on that candle. So they will think the market is buying, but it's actually giving us a stop hunt. Stop hunt means it's a false move against the real trend. So you can see there were orders right in this area, and the market came, shoop, one candle, and then the stop losses got hit. So let's see. On Monday, the market gave us the first low and the second low, so it means we have two lows now. And then we, on the next day, the Tuesday, the market gave us the third low. So it's the first push out of this box, second push out of this box, and then this is the third push out of this box. So this small box represents the Asian session from 12 o'clock until 8 o'clock in the morning. GMT plus 2. It's if you are in Namibia or South Africa. Yeah, so what the market does is this is one pattern which you have to take into consideration. The market will usually move out of this box 25 to 50 pips to induce the traders to go the wrong way, and then from there on they will slowly drive the market in the right direction. So how they do this is they use vector candles. Vector candles is very fast candles, engulfing candles, to induce the traders to go into the wrong way, and usually these signals that will be taken by the retail traders or traders which are using robots and systems, and that's why robots and system doesn't really work. For some people it might work, but it's better for you to also take a look at the market whereby you remove all the indicators and the market is very clean, and this is how you view charts. So let's okay, my battery is actually low. Let me just put charger on. Alright, let's do this. So as we see here, we have the accumulation from the first 8 hours of the week. You just draw the high and the low of those two candles. You draw the let me show you here where you draw it. This, if you go on the 4 hour, if you go on the 4 hour, it will look like this. You see it's the same pattern which happened today, which represent today, but this is just in a larger time frame, but the pattern is always the same. So the patterns go by this. Let me draw it for you guys so you guys will be able to see which pattern I'm talking about. So usually what the market does is the market will come into this zone in the beginning of the day from 12 o'clock to 8 o'clock. The market will then give us accumulation, and then what the market does is after the accumulation the market will usually move out of the box 25 to 50 pips, and then the market will give us the low of the day. The market gives us the low of the day, and then the market moves away from the low of the day because retail traders are now tripped. They go the wrong direction. So after the low of the day the market goes up, and then again the market comes down to the low of the day. So this is now the most interesting part. So if we get this kind of setup, usually what will happen is here is where the market is going to give us a spike. The market will give us a spike downwards to induce more traders to go the wrong way. So usually what you get is in this range where the market gave us the stop hand, the market can give us 3 pushes, 3 candles, like 1, 2, 3, and then we get the low of the day. The market moves away from the low of the day, and then the market will come back. And you have to notice that each and every session has their goals that they have to reach. So this might be the Asian session, and then the first leg will be given in the London session, and then on the New York Open we will get the second leg. So when the second leg appears, you will get a fast move right around here. The market will just shoot down, and you will be like, hey, what's happening? And then the market will again come in reverse. The market will come in reverse and push back very slow, very slow, very slow, very slow, very slow, very slow and steady, very slow and steady, very slow and steady, in 3 pushes again. So we can expect 3 vector candles in this area, and then we get the low of the day. The market moves away from the low of the day, comes back, hit all these stop losses and induce. So this is a tool that they use. So this is what they will do, and they will move away like they can even move away 3 pushes, 1, 2, 3 for example, and then they will give us they can give us the M right around here. They can give us a M. Okay, let me put this in the right way. Okay, they can give us M before they end the day. They can give us the M pattern before they end the day again. Then they will end the day consolidating to get the traders confused and trapped. So the next day you will just see your stop losses are hit. So this is one very powerful pattern which occurs in the market. So we're going to go through the market and check whether we find these patterns. All right, let me just remove everything here. So we're going to go back to the charts. So what you do is, in the beginning of the week, what you do is, this is now Sunday going into Monday, you measure, you draw, you can draw a line right here. It goes from the high and the low of the first two candles of the week on the 4-hour time frame. So let's switch to a smaller time frame and see what happens. All right, so we can see this is what happens in a larger time frame. You can see the pattern is accumulation, stop hand, and then we get our W, and this is our second leg on a bigger time frame, and this is for the whole week. But if we want to see what's happening in a day, this is actually what's happening in a day. We get our accumulation. After the accumulation, we get stop hand, the vectors, the false moves to induce us to take the wrong way, and then we get the low of the day. The market shoots away from the low of the day, the market come back, the market hit all these traders stop losses and induce again traders to go the wrong way. Then the market slowly moves away from these traders, and you can see it's push 1, push 2, and then push 3. So we're also going to look at this pattern on the US30. So we can see, let's take a look what's happening on US30. Let's take a look what's happening on US30, guys. For US30, it's the same pattern. This is a weekly accumulation, and we have 3 hits to the low. This is the first hit, this is the second hit, this is the third hit. But also, if we start to count from the beginning of the week, we'll get 3 pushes down. This is the first push, this is the second push, and this is the third push. So what the market does is, on Monday the market consolidate around this area. This is the first 2 hours. Actually, this is the first 2 candles on the 4-hour time frame. So the market will move out of these areas as a stop hand. As you can see, the market will give you the high of the day, and then the market moves away from the high of the day. The market goes back again to the high of the day, and look what happened. The market fake out to induce traders, or some traders stop losses are hit around these areas, and then look what happened. The market shift away, and the market will never go back to those areas again. And this is a trade that you could have taken around up to here, or you could have taken your profit at this level, because the market moved from zone to zone. On the second day of the week, look what happened. The market gave us the accumulation, the false move, the low of the day, moved away from the low of the day, came back, hit all these stop losses, and then the market shoot right up. You can see the market shoot right up. Let's look at US 500. US 500, the same pattern occurs. So this is also the same what we spoke just now. It's the market fake out to induce, and then they leave traders trap, they push away, and then they come back to the level, and then this is where you enter your trade on the second leg. The following day, you can also see they gave us yesterday's low. This was the previous day's low. They come, they consolidate, and then on yesterday's low, this is where the trap areas are. This is where the trap areas are. So they come back, they give us the low of the day, shift away from the low of the day, they come again to the low of the day, they hit all these stop losses and they induce traders to go the wrong way, boom, and then the market shoots up. So few tips that I want to give you guys is sometimes these vector candles will induce us to go the wrong way. So how we can avoid this is simply by learning these patterns. It will help you build confidence, it will build a transformation, and it will be easier for you to spot patterns, and this will remove all of the fear, and you will master how the market makers work and how they control the market and how they work the highs and the lows. So this is what we have to take into consideration. So we do have risk management, obviously, that we have to apply in our trading strategy also. So if I happen to take a long here, at the second leg of the low of the day, my stop loss will be just a few pips away from the low of the day, or from the second leg of my entry, and then this can be areas where I will be able to take my profit, take profit 1, take profit 2, or simply I can enter, wait for the market to go into profit, and then I will trail my stop loss as the market goes into profit. So yeah, this is one strategy that we have to work on, and these are the market maker moves. They repeat each and every day, each and every week. It doesn't matter, they repeat. So make sure you apply these rules in your trading. It will give you a success in your trading career. That's from me, Patrick Shamokuti. Thank you guys.